Happy Friday, everybody. Welcome to Trading a Smaller Account. I'm Connie Hill, Senior Manager and Education Coach here at Schwab. Sitting in for Barb Armstrong today, she is down at the Sacramento Live event. If you're here in the class, I'm guessing that means you don't live in Sacramento because you are here and not there. But anytime you have an opportunity to hit those workshops, it's a great idea. Now, we've had a little bit of volatility in the market, haven't we? Today, we're going to talk a little bit about maybe what our outlook should be and follow up on some trades. I was here with you last Friday, which was nice. We're going to follow up on the trades that we did that day. And then I've got several outlined for us to work on today. We'll see how many of those we can punch through that are just kind of based on what's going on out in the marketplace. Now, I am joined in the chat by Mike Fairborn. Mr. Fairborn and I are friends. I don't have to call him Mr. Fairborn, I guess. In any case, good friend, very knowledgeable about the markets. He's a great veteran. If you have questions about what we talked about here today, feel free to ask. I'll keep my eye on the chat. Mike will keep his eye on the chat. He might have to pick up some things I can't quite get to. All right, but we do want to answer your questions. And those of you that are listening to this on the archive, when you have questions, go ahead and put a comment in on the YouTube video. Okay, that's how I know that you have a question. I go back and answer those pretty quickly as well. We try to get through those just as soon as we can. Now, I'm looking at so many familiar names and faces, I guess not faces, names. Happy that you had joined me here today. There's one comment that I have to highlight here, though. Let's see, Marcus McLean, I think you can be my new best friend of the day. Marcus says, hey, I didn't know you were going to be here. I think we're going to have a good class today. So I appreciate that. Let's go through the disclosures. Let's talk about how this class works and get down to business. Options carry a high level of risk and are not suitable for all investors. We'll be using the Paper Money software application. That's what you download to your computer. It's the most robust version of Thinkorswim, although there is a mobile and a web version for you as well. In the Paper Money virtual trading account, one thing that it does not do is assign options early. So if there's a circumstance like that, I like to point that out to you. Past performance is no guarantee of future results. Okay, we're going to take a look at the markets. We're going to take a look at how our trades been doing on our Thinkorswim platform. They actually closed out. I'll show you how they closed out. And then we're always going to do some new trades here. So let's do this. Let's talk about this class, how it works. It has, we assume, a $20,000 Paper Money account. At least that's its starting balance. Now, as that account grows, you might change your position sizing because that would be a realistic thing to do in your account as well. But we will not spend any more than $5,000 on any position. And typically that's more related to stock, right? We don't want to risk more than $400 to $500 per trade. We try to keep, well, we absolutely keep below that. All right. That means we're going to be focusing on shorter to intermediate type timeframes. Not typically something that we're planning to buy and hold for a long time. We're going to go both bullish and bearish depending on what we see out in the marketplace. And we've had a lot of rotation recently that you've probably noticed. And so we might want to take advantage of that. So bullish strategies, we'd do stocks, long calls, short puts, buy right covered calls, which I know Barb does every once in a while in here. Short put verticals and long call verticals. And then bearish strategies, long puts, long put verticals, short call verticals. Once in a while, we'll talk about iron condors, sometimes maybe calendars. I don't know that we'll sprinkle in any diagonals or butterflies or anything like that. We'll kind of just stick with some bread and butter strategies that typically are considered a little bit more high probability. All right, let's go out to Thinkorswim. Head over there now. And let's start us out in our charts. Now, I've got the S&P 500, which we use as a general gauge for the overall market. And I've got a couple of things here on the charts. I've got a blue line that's a 10-day moving average that's exponential. This red line is a 30-day moving average, simple. And the 30-day is more intermediate trend. What direction is the intermediate trend going? Right now, the intermediate trend has been creeping up, but maybe just flat in the last couple of days. But the 10-day, you can see the 10-day has been very reactive to price. And so we see it's actually been pulling back here a little bit. Today's giving it a good bounce. If it's a big enough bounce, maybe that'll change the angle of that 10-period moving average. Then I have something down here on the bottom that we'll look at just when we're talking about the indexes. It's called the market forecast. And it's just a study. It's a study that is available to you if you go out and look at your studies. This is an enhanced version, I call it. But let me just show you a little bit. Let's go to our studies. I'm going to type in market F. And this market forecast right here is the one that you have access to. I'm going to put it on. I don't have it on right now. So let me put it on. What I have on here, you can see, is called Market Forecast KR. Okay, which is that one right there. Happy to share that with you. Let me show you the differences first. All right. So here's the enhanced version. Here's the regular version. Now, there are 3 lines, green, blue, red, that are kind of represent different periods of time, meaning the red line's super short term, and it represents maybe 1 to 2 day forecast what could happen, meaning this red line could go from the bottom reversal zone that's below 20 to the top reversal zone up here that's 80. It could do that in a day or two. The blue line kind of maybe represents a little bit more swing trading style. It might take 8 to 10 days to go. Now, sometimes it's faster than that. I'm going to say 3 to 8 days to go from one reversal zone down to the other. Okay. And then the green line is more indicative of the intermediate trend. So I'm just going to kind of zoom in here a little bit where they are right now. And so you can see, yeah, these lines are exactly the same, but this one, it tells you just what the exact reading is of the red, blue, and green lines. It tells you if it's going up or going down. And then it has colored in these reversal zones, 80 and below and 20 and above. Okay, I'm going to share that with you. Some of you may have that, some of you might not. Remember, anytime we share a script with you, it's not guaranteed as to accuracy or timing. It is right here. If you're listening to this on the archive, what you'll need to do is either pause the video, take a look at that, or I will also put it in the comments. We'll put that in the show notes when we're finished today. Okay, so those of you that want to use that, Dom says, yeah, I use that from the Ken Rose days. Yeah, my underscore KR means it came from Ken Rose. He has a lot of great scripts that I use. I try to put that little indicator on there so I remember what wonderful coach or source that came from. So as we're looking at this intermediate would say, well, maybe that's going down a little bit. It's it's down past 80, down out of that upper reversal zone, and it's headed down. And so we say, okay, the intermediate market is headed pulling back a little bit. It's still above 50 right now. It's at 52, but it is falling. But the red line and the blue line, which represent the really shorter terms, notice how they are both going up. So depending on what time frames you're trying to focus on, it might be helpful to just have an idea. Okay, these shorter time frames headed up, longer time frame headed down. Now, if we look at the NASDAQ, pull up the NDX here, and what do we see on it? Well, it's been weaker than the S&P has. I'm going to get rid of that bottom one because I want us to have a little bit more space here, but I wanted to show you the difference. And if I zoom in here, intermediate line definitely headed down. In fact, it's down at about 30.84. When it gets to 20 and lower, that's in the lower reversal zone. It is headed down. So again, our intermediate trend on the NASDAQ headed down. And our blue line and our red line, both of those are headed up. So again, kind of that swing time frame. Of course, today getting a swing in the market right now. We're able to see that. All right. VIX. VIX has been poking its head up in areas where the market's been a little bit more volatile, right? We've had up here 20, what did that get up to yesterday? 23.1. That's how high that got. Today, definitely pulling back. We see that big red candle here, but it's still kind of an area where prices are a little elevated. I've seen spreads be a little bit more wide than we typically we'll see them when volatility is low. So even in things that are really liquid, you're starting to see a little bit of wide spreads. Okay, that can impact what kind of stocks that you use for your trades, because we want liquidity, we want those spreads between the bid and the ask price to be just as narrow as they possibly can be. Okay. All right. Well, let's take a look at how our trades fared from last week. We're going to do that first before we jump into our new trades. This will not take a great deal of time because they both were pretty quick here. Now I'm going to bring up a chart of Gilead. On Gilead, we did a long call vertical, and it was the 140, 145 strike price. I'm going to zoom in here on Gilead. And this is the day we got in. That was last Friday. What did this thing do? Popping out of this nice flag consolidation, nice run up. We know its target could be up here somewhere. It did what we wanted it to do. You can't complain about that, right? And we got out of the long call vertical. It hit our target that we had put in there. It got us out yesterday. So if you go to the monitor tab, you come to account statement, and you look at this, the spread we paid $236 for. We took a really modest, I'm going to say gain on it. We said, hey, if we can get X percent, we're going to get out, and we did. Okay, so that gain was about 42%, and it was for $258. Okay, so just maybe you might call it a little bit of a base hit, right? Every little base hit helps build the account. You could have stayed in the trade longer, maybe hope to get a little bit more out of it if you didn't want to close it here when it hit its target. It's still moving, right? So who knows, maybe if somebody placed a trade and said, hey, I'm looking to get up to the top of the flagpole range to bound 156, right? Maybe somebody's hanging on to see if it really gets that high, doing another kind of trade. All right. Second trade up was MMM, 3M. And on 3M, let's kind of zoom in here. We used the Fibonacci's on this one, and we used them for our target and for our stop. Now, 3M had just really been struggling and broke through this Fibonacci level here that I had kind of tracing this move from the peak point down here to that low point. And we were looking for this stock to go down a little bit to this 161.8 level on the Fibonacci's. We got in here. It dropped another day, but then it rallied back up on Monday. Tuesday definitely rallied up, and then we had put our stop a little bit above this 100% range. So it stopped us out, which is a good thing. It didn't make it to our target. Other ways we could have played this, we could have not used the Fibonacci. We could have maybe gone with these candlesticks here as far as looking like they were reversing. Maybe gotten out a little bit earlier than we actually did when it crossed over that 1%. Okay, so we lost a little bit of money on that particular trade. We bought it for $228. We had to sell it for $116, which was pretty close to half the amount. So we ended up with a $224 loss on that one. So we gained a little bit more from our trade that we talked about first to Gilead. This one changed on us. When it changes, you got to change plans, right? You say, it's not following through with what we thought it was going to do. So yeah, you've got to take an exit there. Nobody likes taking a loss on trades, but it's just kind of part of trading, right? And when things change from what you expect them to be, yeah, you've got to do that. All right. Let's see. Oh, Ron says you're still in Gilead. Interesting. See, I said there could be some people. Yeah. Very good. Let's see here. If you do have too many indicators, it can be a waste of time. I agree. We're really not going to use the market forecast in anything else we're looking at here today, so I'm going to get rid of that. But you're absolutely right. You can wait. You can have a bunch of studies on there and hope that they will all correspond at the same time, kind of giving you, you know, a golden arrow that things are going to go up or down in whichever direction, right? But you can also get analysis paralysis, waiting for all of them to try to line up for you. Okay, right now we're just going to use some moving averages. Now, one thing we'll do a lot in this class is we will use spread trading. Why spread trading? Because there's a couple of reasons, I think, okay, that traders might want to use spreads. One, you have defined risk, typically defined risk, defined loss, and that kind of can help you with your position sizing, with the amount of capital that you use, because typically a spread trade does not cost you nearly as much as buying stock outright. Okay, so first one we're going to look at, well, actually, one other thing I wanted to show you here, to go to the Market Watch tab. I have pulled up this watch list that's a public watch list. It's called S&P 500 sectors. Sector indices, I should say, is the full name of it. It gives you this number. Honestly, I don't have all these numbers memorized, but these are the sectors that they represent. And I've got a couple of columns here that are helpful to use in determining where is there strength in the market, where is there not strength in the market. Now it's doing some recalculating here. This column is a 1 month percent change, basically. This one is a 13 weeks percent change or return. So basically a month, basically a quarter, okay? And sometimes what I'll do is I'll look at this and just kind of see, well, which sectors seem to be having the most success right now, looking at both that 1 month time frame and 3 months time frame. Now, this has really taken a long time to refresh it. I had it refreshed before class started, but when you go off that screen, it doesn't sometimes keep it there, okay? But I will tell you that energy is the one that's performing the best in this 1 month. So interesting: energy, healthcare, real estate, and consumer staples. Now, I've seen a lot of industrial stocks continue to perform well as well. Now we finally get kind of a view of this. And so we can see, yeah, generally, those are the ones that have been outperforming, actually, mostly in both time frames. We don't see what the energy is right here. It'll probably pop in a moment. So it's nice if we kind of go fishing, right? Go fishing where the fish are biting, right? Wherever the stocks happen to be going up, maybe put your emphasis in that sector, looking for those kinds of stocks. So that's what we're going to do today. We're going to do some stocks from the energy sector and from the industrial sector and the building materials as well. Okay. Consumer staples might be an opportunity as well. It's rare that we see a lot of defensive things performing with non-defensive things, or cyclicals performing with non-cyclicals. Okay, so it's kind of an interesting makeup and really some nice fishing holes to go to. All right, first trade we're going to look at is going to be an energy stock. Let's see how if it's still looking as good right now as I thought it was this morning. And so here we have well above the 10-period moving average, way above the 30-period moving average. And if we're looking at this a little bit more closely, what you might see here is you might see, well, we had a nice little flag pull, little bit of a pullback, and breaking out of this flag consolidation today, just a big, strong move. If you're like, I don't know about flag pulls yet, that's fine. You don't need to. What you might be observing, though, is, oh, look at that. Look how it broke through that, maybe some short-term resistance in this 195-ish area. Okay. Well, what kind of a move can we expect when a stock breaks out of a flag pull? Now, this is a little bit of an expensive stock. It's over $200, but our expectation from a technical point of view is we expect it to run the amount of the length and the height of this flagpole. So I'm going to duplicate the drawing. I'm going to click and drag it. I'm going to do a little bit more aggressive target for it, I should say. I'm going to put it here where it's breaking out. You could also, if you wanted to, put it back here, maybe where you see the bottom flag area being. You could put it back there, and that'll give you a more conservative target. like I said, I'm just going to do the more the more aggressive one today. And if somebody were looking at maybe a swing trade, you might look at this as well. That target ends at about 217, so $217. So another 16-ish dollars, maybe 15-ish dollars to go, which is a decent size move on the stock. Well, because these options are probably going to be a little bit more expensive, probably going to go the vertical route as opposed to buying the options outright. We're out here, we're looking at the March options, and we can see lots of open interest out here. That's helpful to see. One thing that's new that hopefully you guys are becoming more aware of is that there are some additional, well, actually this one doesn't have it. This just has every week, 6th, 13th, 20th, and so forth. Generally working with verticals, we look for 20 to 40 days worth of time is a sweet spot some traders like to use. But if there's not liquidity, meaning not lots of open interest in your puts and your calls in those weeklies, just move to the monthly, right, that has enough open interest. So this one I would say, yeah, we're just going to go out. We're going to use the March 20s. And let's see if the one I had in mind here still seems to apply. See if it still makes sense for us. I was looking for us to do a short put vertical, doing the 165 or 170, 165, but it has shifted so much. It's continued to go up quite a bit. We're going to have to probably come down here a little bit more to get to a 30-something delta. And, you know, the spreads down here aren't too bad. They are getting a little bit wider through here, which I'm not liking to see $1 spread on that. That's kind of a little too much. And like I said, initially I had targeted for us to go 170, 165, but it has moved a little too much there. So we're gonna shift gears here. We're gonna do a long vertical. Spreads are well, I was thinking that was a little bit better, but maybe it's not. Okay, we're going to go on to our next trade because I want to see if that spread tightens again. It was pretty decent earlier today. Don't want to break our rules. I was going to say we could come over here where there's a lot more open interest and do a long vertical. Spread is still a little bit wide here. Let's do this actually. Let's do where there's a little bit more liquidity. And we'll just start without the money, buy a vertical. But what we're going to do here is we're going to put in a number that's a little bit more healthy. And so we'll see maybe if it will pull back a little bit, spread and fill us maybe at a little bit lower price. So we're going to come, well, we'll leave it at that midpoint price. It's not likely to fill there. But if it were to fill there, that would be a lot better than paying $4.85 for it. Okay, so we'll go ahead. We'll leave it there. It does, well, it trades in nickel increments. Let's pop this up to say 430. Okay. If this had really light open interest, like maybe some of these single digits here, we would not probably be as excited to do it, right? But there is a lot of open interest here. And many times what will happen, the spreads will widen out a little bit and then they kind of tighten back up. All right, so we're going to do this one. We're just going to do one contract because we don't want to risk more than $400 to $500. That'll keep us below our $500. And let's also put in here in order to buy it back if we get a chunk of our gain. Okay, so we'll do select trade in opposite order here. And if our max loss here is 430, then we know our max potential gain is what? Is that going to be 570? We won't expect to get all of 570. Okay, but what if we got a chunk of it? Let's just run the calculator here with the numbers. Let's go ahead and clear that out. And let's maybe put the calculator where we can see numbers a little bit better. Okay, so to calculate, you do $10, the difference in the spread, minus whatever that long debit is. So 430 difference is 570. What if we get a chunk of it? And maybe in this case, maybe have a decent chunk because the spread's being a little bit wide. Maybe that can help offset that a little bit. So what if we get 70% of it? Okay, let's say times 0.7 would be $3.99 or basically $4. Let's add $4 to what we might sell it for here. So let's go $8.30. Not trying to catch all of it, okay, but just a decent chunk, and we'll make this good till canceled. And we'll see if that fills. Now, the midpoint price is kind of creeped up a little bit here to 445, so we're going to leave our order the way it is. It might not get filled. If it doesn't get filled, that's okay. We're all right with that. We'll put it in this bucket. We'll see how that one fares. I don't know how that one's going to fare. Let me make sure. Implied volatility is high, isn't it, is one thing from OMK. Implied volatility here on this, the one that expires today, super high. Yes. These down here, I would say they're in the higher range because they're above 35, but they're not extreme. When you see stuff in the 50s, 60s, 90s, 100s, those are more extreme. Okay, so good question. It is in the high range because it's above 35, but not super high. Okay, and these down here about 39% implied volatility. So yeah, I would agree with you. Let's see. Charles says, maybe we could have considered a 188, 180 short put vertical. Well, let's look. 188, 180, and you might have been looking at maybe one of the weeklies to get those single digits. Maybe, well, I don't know if you were looking here. No, those aren't single digits. Yeah, I don't know that any have those single digits in Valero to do that. So not sure if I read you right there. If not, correct me and let us know. Now, one thing here that CB mentions is that it's almost 10% or 7% off the 10 exponential moving average. That's true. It is. And therefore, that's why we're going to keep a little bit longer of a target. Could it pull back? It could. And if it were to pull back to this 10, you know, it would be falling in this flag consolidation area, right? And when you're playing a flag pattern, if it does that, it's broken, you just typically exit the trade. Okay, it's like, it's not following through with that pattern, therefore we're not going to stay in the trade. But I think that's not a bad thing to observe, but that's not why we're trading it. We're not trading it for the bounce off the 10-day, we're trading it for the flag pattern. Okay, so great qualification. Oh, Charles is saying March 20 puts. Okay, well, let's look at one other here. We'll see if this one is still holding up here. Alaska Air. What's going on in Alaska Air? Looks like it recently had kind of maybe a breakout above this 53, 54 area. Nice to see. However, it too is in a flag pattern. And let me just maybe zoom in here a little bit. So here, I mean, somebody could take a really long flag pull, maybe starting here. I don't like the little pullback here. On a flag pattern, I'm really just looking for that sharp vertical move up. So I had 3 days of doing that, maybe to about right there. And then maybe just a couple of days of pulling back, and boom, it's breaking out here again. Now that one is up a little bit here, 6.42%. It might retrace a little bit. I'm going to skip this one. Let's go to one other one here. MT, which is a mining stock. It's also a foreign company. It has this little ADR here that lets us know, hey, this is a foreign company. That means it's going to have a little bit more risk with it. Luxembourg is where they are headquartered. And so if it were maybe, say, in a region you weren't comfortable being in, whether it's a European, Asian, Eastern, whatever it happens to be. If you're not comfortable in it, then you might not be interested. But it tells you where they do mining business: Americas, Europe, Asia, and Africa. And one thing this stock has been doing is it's been moving really well. I'm going to come back over here, and I'm going to open up this little watch list here, and I'm going to come down to MT. And where did he go? Well, he was on this little list. That's how I found him. But I'll show you from, maybe I will, since I'm not seeing him, I just type him in here. Wanted to show you the kind of returns that it's had. And maybe I'll organize that by alphabet so I can find it. Here's our MT. I'm not sure why it's not highlighting, maybe because it was still loading. It's up quite a bit today, but this little stock has been on a tear, okay? Notice how since November, since Turkey Day, it stayed really bouncing nicely above this 10-period moving average, okay? It's been moving quite quickly. The 1 month here is 28%. And we can even see back in, it was down here at $36, $37 in the first part of November. Okay, so yeah, this thing has really done a lot of moving as materials and mining stocks have become more part of the environment, right? And seen as necessary to build up the infrastructure for all this AI computing. So this one's up a little higher than we might feel comfortable with, but this is what we're going to do. We're going to see if we can't maybe get filled here down in the gap, okay? Maybe it's broken above the short-term resistance, but not quite as high as it is. So we're going to see if we can get it to pull back. That says 57.96. I'm going to go with a straight 58, okay? Where would we put a stop loss? We would put it below the 10-day. It might not feel quite so scary if we got in here, 58, and it pulled back to the 10, that's much closer to where it is right now, then maybe the price that it is popped up to, right? Because this would be a pretty decent pullback if we kind of came along here pretty close to where today's price is. And if I were to come back here and go under the 10-period moving average, that's about, let's say, 9.8% in terms of how much it might pull back. So we're going to be a little bit more conservative on this one. Let me write that price in here. We are going to do, I just need some scratch pad here. We're going to put that at 58, and let's calculate the stop loss. The stop loss here, we might go just a little bit, would give it a little bit of wiggle room below the 10 versus like right smack at it, right? So let's maybe go, let's go below 54. Let's go to 53.90, okay? As the stop. Well, how many shares can we get here? This class sometimes will buy shares, not a lot of them, but when the stocks are not super expensive, that might be something that we can do sometimes, okay? So the risk on this trade is going to be where our stop will go, 53.90, and we're going to subtract the current price of the stock, $60.92. That's risk of 702 on the trade. I'm just going to jot that little number down here. That's the risk per share. But we don't want, oh, I did the calculation wrong. Let me redo that. We don't want to get in unless it's 58. So actually, let me redo that. Let's go 58, price we're willing to get in at, minus stop loss of 53.90. Okay, 410. 410 is the real risk on the trade that we would assume there. All right, let's take $500, our max theoretical loss, divide that by 410. How many shares could we do? We could do theoretically 121, 120 shares. If we were to do that, would we be spending more than $5,000? We actually would, because the price of the stock would be 58. 58 times 120 is going to put us over our threshold of $5,000. Okay. So what we're going to do here, we're going to keep it under that threshold. We're going to go $4,500, okay? So we'll go $4,500. We're going to divide that by the price we're willing to get in at, which is 58. And therefore, we're only going to do 77 shares. Okay, did you follow along on that position sizing with me? I hope so. All right, we're just going to do 77 shares. Fib zones, talking about fib, some mining stocks have become quite expensive. They've been on a roll, which is why we don't want to chase it too much, and why we'd want to keep our stop loss, you know, kind of around this 10, gradually inching it up so that we kind of continue to inch it up if the stock continues to move, while at the same time letting it pull back a little bit, right? Because stocks just don't go up all the time, right? We can see that. Let's make the trade. Select on the ask price. We're going to do 77 shares here. We don't want to get in unless we can get this at a little bit cheaper price. We're going to go $58. So we're going to say, do not fill me unless you go down to $58. Now, if you aren't filled in a few days, you know, you might go back and evaluate it, see if you still even would want it to be sitting out there as an order. For the moment, we'll put it GTC. Not likely that it's going to pull back. I mean, it could pull back today, but we'll put that as a GTC, okay? It could take a little bit of time for it to maybe, if it will even pull back, it might not pull back. All right, let's go ahead and send our stock trade in here, and we'll put that in this bucket. Question here from OMK Jar. Wouldn't we want to wait till we get certain confirmation that consolidation is going to happen or a new bull flag is being formed? Is a 3 ATR extended? So that could be totally a different approach, right? To say, well, I think it's maybe going up already. Maybe wait for it to form something else. You certainly could, right? You could say this is kind of a decent size move. You can see where our limit order is here, that we don't want to get filled unless it pulls back there. And that's what could happen. It's not guaranteed to pull back. I mean, it had this little gap here, and then it actually gapped the second day, but then went sideways for a little bit. It never really pulled back to fill either of these gaps. So we don't know if it will. It might not. Is it wise to add LMT in terms of like a limit order that we don't want to pay below a certain number? We could do that as well and really kind of fine tune that. I did put that order as a GTC, right? Because we don't know if or when it's going to happen. And really, it had a great reaction. Let's see if they did that yesterday. They had a good reaction to their earnings. A lot of volume moving in, and then today some additional movement in that volume. Texas, is there any reason why you didn't put the buy limit and stop in the same order entry? I didn't plan out that far. Let's see here. Let's come over here to our activity, working orders. Sometimes it's helpful to see if you get filled before you put in a stop, but you could put in that stop order right now. You certainly could. We've already got it calculated, right? We said if it drops to 53.90, then we wouldn't be interested. Sometimes I'll wait to see if it actually fills first, and then see if I'm still comfortable with that, want to adjust that, okay? So either way, you certainly could do that. Those that want to do a lot of automating, absolutely, that's a great idea to do. All right. Let's see if there was anything else I missed here. I think we're up to date. Fib Zone says there's pluses and cons to using an ETF, which is true. We can't really talk ETFs in the class. Hopefully you were to the class this morning. James Boyd ran that class solo. Sometimes he'll run that with Kevin on ETFs, but you've got to be there to catch it live because we can't repost the ETF webcasts. Okay. All right. So we've done a spread trade. We've done a stock trade here. Let's look at I'm just going to go through a couple of ticker symbols, see which ones look the best here real quick, okay? I want to review ALK and that flagpole. That might be one we say, hey, let's see if it'll pull back a little bit, right? Like we're doing on our MT. I'm going to pull up BVN. This is another mining company. That is, again, another foreign company. If we come over here to analyze where is it headquartered? It's in Lima. I'm guessing Lima, Peru. Again, another miner. And some of these countries are really rich in what they can mine. And because of what's going on in our global environment and needing these precious metals, these materials, these guys are really taking off. Now, the one thing that was interesting about this one is, yeah, it had a high price there, ran up there, but it pulled back a little bit for us. And so this one, yeah, it's staying above the 30, but it looks like right now it's trying to bounce off that 10-day, which means we wouldn't necessarily have to wait for it to pull back to try to make an entry on it, okay? Where would we want to put a stop? Well, it depends on your risk tolerance, if you're willing to let it go below the 30. If you would say, we're maybe looking at this maybe as a little bit short term of maybe a swing trade, where we'd say, you know, if it goes lower than the low today by a nickel or a dime or whatever, get out. And if we said, maybe it'll come up here, hit this area again, this 41-ish area, maybe put that as a target. Okay, so we're going to go target 41. And the low right now today is 35.64. If it goes lower than 35.54, that would be our stop loss. Okay, so just a quick little swing trade, looking for it to get back to its high peaks here. Doesn't mean it will, but it is a price of a stock that we can fit in our budget. We probably in this case don't want to do more than 100 shares, so we'll just keep it at 100. That'll be like a $37-ish or $3,700. Could round it up to, say, 120 if you wanted to. We'll just leave it at 100. And then let's do this. Let's do our first triggers OCO. So we'll put in that target and that stop. Actually, let's do it this way. This is more efficient. Create an opposite order. And we'll put both of those in the order. Now we've got to make this a market, and we're going to put in stock price conditions here of when we'd get out, when would on the top side or the bottom side. So if it gets greater than or equal to 41, that's where our target is. We'd be happy campers to get out there. If put in, click there again, and if it gets less than or equal to 35.54. That's our target. And if it gets less than or equal to 35, let me get out. Let me make sure I've got my arrows the right way. Less than, and this one needs to be greater than. Move that little arrow. There we go. Greater than to 41 or equal to, or greater than or equal to or less than 35.54. Trigger a market order, get us out of the trade. We don't know what the price would be, and it's not guaranteed, but we just would know that we need to get out based on those, either one of those conditions. Okay. We're going to send this little guy off. We're going to put him in this bucket of trading a smaller account. I know Barb is doing a lot of traveling this very first quarter of the year with these, with a lot of workshops we've got going on. I think she's going to be here next week, so I wouldn't necessarily follow up on this trade next week. But if I have a chance to update you about it, I will do so. So watch me on my Twitter feed. Right, I'm Connie Hill CS. Mike Fairborn does a lot of fun posting as well. Mike Fairborn CS. You want to follow us, and that's how you can communicate with us. Now, I also hope you found the subscribers page, right? Down in the bottom right-hand corner, there's that little YouTube-looking logo. It says subscribe to our Trader Talks channel. That's where you can see what's coming up, right? Advanced Charting Techniques is up next with Cameron May. You can see our playlists for each of the classes. You can see this little bite-sized content. This one I did a couple of weeks ago on letting the charts find a Kahold candle for you. I also did that in Mike's scripting class last week. We had a lot of fun with that. Okay, you guys, so there's extra content that it would just be nice if you were able to find it conveniently. And by being a subscriber, you can do that. All right. If any of these trades you want to do in your paper trade with you following along, sometimes that's the best way to learn, even if it's not a strategy you're comfortable with or a process you're not comfortable with. Doing it out in your paper account is where it's great to learn lessons. All right, we're going to send you loose. Go get a beverage refresh and a snack if you need it. I did not see a survey out here today. If you found this helpful, hit the like button on the way out, and we'll be back here right at the top of the hour with Cameron Main. We'll see you then. Bye-bye.